In the previous episode, we established what we called the transparency trap, the systematic condition in which high net worth individuals operating under legacy domicile structures become structurally visible to an expanding network of tax authorities, information sharing regimes, and regulatory bodies operating under the Common Reporting Standard. The CRS, now active across over 100 jurisdictions, has fundamentally redefined what financial privacy means at the institutional level. It has collapsed the traditional distinction between onshore and offshore asset positioning. It has weaponized correspondent banking relationships as disclosure conduits. And it has transformed what was once a matter of bilateral tax treaty negotiation into a multilateral surveillance architecture. The critical insight from that episode was this: the transparency trap is not a temporary compliance challenge to be managed. It is a structural condition of the modern fiscal environment that demands a structural response. Incremental compliance adjustments, changing account signatories, restructuring beneficial ownership on paper, layering additional holding vehicles do not constitute a structural response. They constitute structural exposure dressed in the language of planning. The investors who are navigating this environment successfully are not doing so by becoming more compliant in a reactive sense. They are doing so by repositioning their fiscal residency, their operational substance, and their capital structure within jurisdictions that offer what we term structural defensibility, meaning the legal, regulatory, and treaty architecture necessary to make their position durable under audits, under mutual legal assistance requests, and under future legislative shifts. That is the distinction between accommodation and architecture. And in this episode, we move from theory into implementation. In our mechanics episode, we introduced the foundational framework of the sovereign shelter, the integrated structure through which fiscal residency, repositioning, capital migration, and entity rationalization combine to achieve jurisdictional arbitrage at a level that is both legally defensible and institutionally durable. We mapped the three core pillars. First, the establishment of genuine economic substance in a target jurisdiction. Second, the strategic sequencing of exit from legacy domicile structures to minimize exit tax crystallization. And third, the selection of a jurisdictional network whose treaty architecture provides treaty protection, mutual recognition, and information exchange reciprocity on terms favorable to the structuring objective. What the mechanics episode did not address by design was the implementation sequence itself. The sequence in which these pillars are activated determines the tax efficiency of the entire structure. It determines the extent to which unrealized capital gains are triggered at exit. It determines whether the residency position will be challenged by the legacy jurisdiction's departure rules. And it determines whether the ongoing operational substance in the target jurisdiction will satisfy the economic reality tests that are increasingly being applied by both the OECD's BEPS framework and domestic anti-avoidance provisions. Sequence errors are not correctable after the fact. A premature triggering of exit tax exposure, an incomplete break of fiscal residency ties, or an asset migration that precedes the establishment of qualifying substance. Each of these represents a structural failure that forecloses planning options that were available before the error was made. This episode addresses the implementation sequence with precision. Every step has a place, every step has a logic, and the order of execution is not optional. Jurisdiction selection is the highest leverage decision in the sovereign shelter architecture. It is also the most frequently mishandled. The dominant error among advisors below the institutional threshold is selecting a jurisdiction based on headline tax rates alone. A 0% income tax rate in a jurisdiction with shallow treaty networks, limited regulatory credibility, and no mutual recognition framework is not a planning asset, it is a liability. Jurisdictions that provide genuine structural defensibility operate at a level of analysis beyond tax tables. They are defined by a selection matrix of three non-negotiable criteria. First, sovereign stability. This is not superficial political stability, but institutional continuity, the proven capacity to maintain treaty commitments, regulatory frameworks, and legal architecture despite external pressure from larger economies seeking to renegotiate or withdraw access. Second, treaty network depth. A jurisdiction's value is proportional to the comprehensiveness of its double tax treaty network and the quality of its competent authority relationships. Your domicile anchor must be tested and upheld in formal dispute resolution contexts. Third, operational substance. Under the BEPS action plan and the global minimum tax framework, substance is no longer aspirational guidance. It is an enforceable condition of treaty access. Your target jurisdiction must offer an environment where genuine economic activity, management control, and human capital can be established, maintained, and documented to a standard that withstands competent authority scrutiny. Do not conflate tax rate with planning value. These three criteria, stability, depth, and substance, form the only matrix that ensures long-term structural defensibility. While primary residency jurisdictions such as Malta, Cyprus, or Portugal must be verified against recent legislative shifts to withstand departure challenges, they must be strategically layered with secondary structuring jurisdictions like the UAE, Singapore, or the Cayman Islands to optimize capital efficiency, provided these two distinct functions are never conflated. The implementation sequence begins not with the target jurisdiction, but with the legacy jurisdiction. Before any movement of fiscal residency is initiated, a comprehensive exit analysis must be completed. This analysis identifies all assets, entity interests, trust arrangements, and deferred compensation structures that will be subject to deemed disposal or crystallization upon departure from the legacy domicile. In high-value cases, particularly those involving unrealized capital gains in closely held businesses, real property portfolios, or equity-linked remuneration arrangements, the quantum of exit tax exposure may be the dominant variable in the entire planning exercise. Managing that exposure is not a matter of avoidance, it is a matter of sequencing and documentation. Certain asset classes may benefit from pre-departure restructuring, the conversion of personally held assets into corporate or trust structures at current market value, the triggering of specific treaty elections, or the acceleration of transactions that would otherwise crystallize post-departure at higher effective rates. Each of these interventions has a legal basis, a documentation requirement, and a timing constraint. None of them can be executed retroactively. Once the exit analysis is complete and the pre-departure interventions are in place, the residency filing sequence is initiated. This involves the formal establishment of physical presence and economic substance in the target jurisdiction, the formal notification of departure to the legacy tax authority, with supporting documentation, demonstrating the completeness of the residency break, and the submission of the final tax return in the legacy jurisdiction covering the departure year. The documentation standard at this stage is not administrative, it is evidentiary. It must be assembled as if it will be challenged. Asset migration follows the establishment of confirmed fiscal residency in the target jurisdiction and the formal completion of departure obligations in the legacy jurisdiction. The sequence is not interchangeable. Assets migrated prior to the confirmation of fiscal residency in the target jurisdiction may be treated as having been acquired by the individual in the legacy jurisdiction, triggering the very exposure the migration was intended to avoid. The migration sequence itself is stratified by asset class. Liquid financial assets, listed securities, cash positions, money market instruments can typically be migrated through straightforward account transfer mechanisms, subject to the correspondent banking considerations that apply in the target jurisdiction and any withholding obligations that apply in the legacy jurisdiction to departing residents. Illiquid assets, real property, private equity interests, closely held business stakes require a more granular approach. The jurisdictional status of these assets, their existing ownership structure, and the applicable treaty provisions governing capital gains, dividend withholding, and deemed disposal will determine whether direct transfer, entity-level restructuring, or a hold and manage strategy is optimal. In the context of trust arrangements, migration requires particular care. The residency of trustees, the governing law of the trust instrument, and the treatment of the trust under both the legacy and target jurisdictions' domestic rules. Each of these interacts with the migration to produce outcomes that may not be visible without a full structural review. Compliance continuity during the migration period is not optional. The individual remains subject to reporting obligations in the legacy jurisdiction until departure is formally confirmed, and simultaneously begins accruing obligations in the target jurisdiction from the date fiscal residency is established. The institutional checklist for a sovereign shelter implementation is not a standard advisory engagement. The complexity of the legal, tax, and regulatory inputs demands a team architecture that operates across disciplines and jurisdictions simultaneously. At the lead advisory level, the engagement requires a tax counsel team with demonstrable competence in both the exit provisions of the legacy jurisdiction and the domestic fiscal framework of the target jurisdiction. Generalist international tax advice is insufficient. The counsel must have active practice in both jurisdictions, with specific experience in high-value departure cases and the competent authority dispute resolution processes that apply when those cases are challenged. Alongside tax counsel, the structure requires dedicated legal capacity in the target jurisdiction, covering entity formation, regulatory licensing where applicable, and the substance documentation that will underpin the residency position. This is not a role that can be delegated to a registered agent operating on a standardized service model. It requires practitioners who understand the evidentiary standard that competent authority scrutiny demands and who can produce documentation that will hold under that standard. Banking and asset custody arrangements must be established in the target jurisdiction prior to asset migration, with full KYC and AML compliance documentation in place. The corresponding banking architecture must be reviewed to ensure that transfer instructions will be processed without blockage by intermediary banks applying their own jurisdictional risk frameworks. Finally, the engagement requires a compliance continuity officer, internal or external, whose function during implementation is to track filing deadlines, information exchange triggers, and reporting obligations across both jurisdictions. The implementation window is the highest risk period. Every missed obligation is a structural vulnerability. The sovereign shelter is not a tax scheme. It is not an avoidance structure in the pejorative sense that has come to dominate public discourse on international tax planning. It is a recognition that the global fiscal architecture has shifted fundamentally and permanently, that the Common Reporting Standard, the BEPS framework, the global minimum tax, and the expanded reach of domestic anti-avoidance legislation have collectively created an environment in which legacy domicile structures no longer provide the protection they were designed to offer. The investors who understand this are not responding with opacity. They are responding with architecture. They are repositioning their fiscal residency, their entity structures, and their capital through a sequenced, documented, legally defensible process that achieves structural defensibility within the parameters of current law. That is not evasion, that is execution. What we have laid out in this episode is the implementation framework at its core, the exit analysis, the residency filing sequence, the asset migration stratified by class, the advisory team architecture, and the compliance continuity discipline that holds the structure together during the transition. Every element of this framework exists in current planning practice. Every element has been executed successfully by individuals and family offices who engage with it at the right level of institutional rigor. The question is not whether this is available to you. The question is whether you engage at the level it demands. The Sovereign Shelter Briefing is a private, jurisdictionally specific advisory consultation for individuals at the implementation threshold. Access the link below. The architecture is available. The window for optimal sequencing is defined by your position, not by calendar time. Act accordingly.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.